My name is David Pieper. I'm the co-founder of Intalcon, and I'm also responsible for our systematic strategies, our algorithm. And in the next 15 to 20 minutes, I will be just in time for getting our coffee. I will present to you how we work, how we implement our algorithms, and how we try to generate impact with the funds that we create. So I would first like to start with the first slide here. I'm pretty sure you know that although we made a lot of progress on the road to the goals of 2030, we see the SDGs here, we are still behind the curve, and we all know, and we learned this today, that there is a lot of money that is needed to finance the transition, to finance and support projects. And we have been thinking about this a very long time, since we come from the algorithmic trading space, and we thought about, okay, how is this happening? There is so much money invested in funds, in different projects, and there must be a way to generate a better return in order to make a difference here. So we started two companies. Basically, on the left side you can see this is the Intalcon GmbH. This is our, let's call it, alpha generator. This is the company that includes our algorithm design and our financial advisory role. We also have our own fund, which I will talk about later on. And we are also planning to establish a UCITS fund, so we will become a financial advisor very soon. In order to make the impact measurable and really transparent, we thought of, okay, why not really separating those two things? There is one company who is responsible for the algorithms that generate alpha, that generate returns to our investors. And on the other side, there is a separate company which is a foundation. It's completely non-profit, so it's totally clear and transparent that the money that we generate on the left side, part of this is being donated to the foundation, which then again generates impact. So we have the alpha generator and the impact generator. And this is what we call alpha for impact. This is our claim. And the alpha is generated by using systematic strategies. This is what I will speak about today. And in the end, I will show you how we generate the impact and what kind of projects we support. The first question is that we have raised ourselves, where's the alpha? Everybody speaks about alpha, each product is named something with alpha. It seems that it's only alpha out there. If you look at the numbers from Standard & Poor's, you can see quite the opposite. These are the numbers for 3 different regions for the last 5 years. And you can see that the majority of fund managers, professional managers, these are equity funds, do not beat their benchmark, right? So to me as an investor, of course, this is a disappointing thing, because I pay the fund manager in order to be better as the benchmark. Otherwise, I would buy an ETF, right? Which is very cheap nowadays. So this is the one problem, there is no alpha. So we thought about, since we have a long experience with a software that we have been selling, and which is built around algorithmic trading, and we have a lot of experience with clients helping them designing and testing algorithms, we thought about, okay, why not using this knowledge and bring it into the space and create alpha and use it for something good. And maybe you didn't hear of us before. We are a young company. We have been founded 2-3 years ago. So I would like to show you what we are doing already for more than 10 years. What you can see here is our Family and Friends Fund, which is an offshore fund, so it's not a UCITS fund that you will find at your local bank, of course. So it's a hedge fund that we run with our own money. It exists for more than 10 years. And if you look at the performance numbers, I hope you can still see while it's in the yellow-green color. If you look at the last 5 years, you see a compounded return of 29%. And you can see also the chart. And this is what we mean by alpha, right? So we want really to use our algorithms to create above average returns for our investors. This is what we want to do. That's why we opened this fund last year to specific investors to professional investors who can invest in this fund, but still it's an offshore product. So we are, of course, not able to sell this as a normal equity fund, right? So that's our history so far. And if you look at the numbers here, this is the Sharpe ratio. So I'm pretty sure you're familiar with this. It's basically taking the average return of your fund and divided by the risk. So it's a risk-adjusted measure. If you compare it with other benchmarks, you can clearly see the benefit of the algorithms that we apply. And this is for the last 5 years. Here's another example of our equity strategy. It trades US equities, very liquid stocks. And you can see here the green line, this is the algorithmic strategy, and the black line, this is the benchmark. And what this shows is that the drawdowns are not only smaller, they are also shorter. So for our investors, this is a good way to also reduce risks by using such kind of products. If anybody is interested in following the performance of the fund, you can clearly follow this, for example, on the website on Vista or on other websites. If you type in Intalcon, you will find the weekly prices. So they are tracked here and on other websites, so you can follow the performance of our offshore fund. And maybe at this stage you might ask, how can you do this? How can you achieve 29%? The last 5 years, especially the last 2 years, haven't been that easy. So how can you really generate 29% per year? Well, we use algorithms, and I would like to start with this quote here. I'm pretty sure you're familiar with Daniel Kahneman. He's a Nobel Prize winner for the prospect theory, and he also wrote the book Thinking Fast, Thinking Slow, which is I think it already became a bestseller. That's great, I like it. And he says if you can replace judgment by rules and algorithms, they'll do better. And this is the exact philosophy that we count on. This is something we believe 100%. It's not about making predictions, it's not about telling big stories about where the markets are headed, making great studies of 50 pages with colorful charts. It's all nice. But in the end, it's entertainment. And our investors want to have a real return. They don't care whether you make nice brochures, you have to be right. And I would like to give you an overview, a very short one, why we use algorithms, why we rely on algorithms. The first thing is there are many behavioral biases that influence our decision making. And this is if you look at academic research, this is totally clear that every one from us, since we have the DNA which is hundreds of thousands of years old and the financial markets are just 300 years old, we are programmed in the same way, right? So when it comes to markets, we are really in the wrong place as humans. That's the main message. So our emotions typically overwhelm our logic and rational thinking. And this is true especially when the market is really in a stressful and very volatile environment. And the result is that we underperform. And this is true for both the retail investors and the professional investors too. They all fight with the same challenges. For us at Intalcon, this is a great news. Why? Because behavioral biases, they show up in the charts, in the markets with specific patterns. And these patterns, if you can extract them, can be used in order to generate a better performance by using algorithms. So to give you an overview of what we do, our investment algorithms are fully systematic. So the entry, the exit price, the position size, the stop loss for the risk management, everything is being defined by the algorithm, 100%. There's no discretionary input by saying, oh yeah, I think the Federal Reserve will do this or that, or I think this will happen. No, everything is coded in the model. It's hard to believe for our ego to cope with this, that there is a model that is better than us. But if you start thinking like this, it's better for your returns. And one thing that we have learned across many years when we have been consulting professional traders in the energy and banking space is that the main danger of using algorithms is that people over-optimize them. You know the example where somebody is using more and more inputs, optimizes the algorithm until it works perfectly in the past, but once it's applied to real prices, it stops working. So for us, the most important thing is that the algorithm is robust, right? So it has to cope with different markets, with different market volatility regimes and different time levels. If you ensure that, you are on the right track and you are able to generate great returns, and our goal is always to achieve a Sharpe ratio greater than 1. Now, just one short deeper dive into the algorithm. I don't want to talk about algorithms on an afternoon too long, but to give you a short idea, maybe some of you are more interested in what we do. So it's always a combination of different single algorithms that we put together. Think of an algorithm like a portfolio manager. Each algo can do some things better than the other one. And if you put together a team of portfolio managers or algorithms which have different strengths and weaknesses, this really leads to an optimal team. It's the same as in football, right? And this is what we do. So we rely on very different algorithms, but the input is always the price. It's the price, it's the volatility of the market. Why? Because we think the price of today is the best proxy for the price of tomorrow, since the market has a memory, because it's run by humans. And here is a simple example. It's not an actual algorithm that we are using, but just to give you a rough overview what could be the rule set for an entry in an equity or, let's say, in a bond future. You can see that there are several rules on the right side. If a specific number of days the market has gone down, and then depending on the high and low prices, if all of the rules are fulfilled, then there is an entry at the green arrow. So this is just a simple overview, just a symbolic overview of algorithms, how they work. Now, in order to get a bigger investor base and in order to grow, since we are a young company, we have decided to create a UCITS fund. This is what we are working on right now. And I would like to give you a rough overview of the product that we are launching at the end of 2023. So it will be a multi-asset, multi-strategy investment fund, a UCITS fund, with a core focus on equities. So it's just public markets with a strong focus on the US. Additionally, there will be index futures, bond futures, and forex futures, which will be traded on the long and short side. So one of the panelists said before that we need more diversification. I agree to that. And what I expect from a good fund is to really use opportunities in the market. For example, in the last 12 to 15 months, interest rate just go up. Means the interest rate prices are going down. The bond futures are going down. An active fund needs to short this movement, right? Or you can hedge your equity exposure. This is what we do with this fund. It's fully systematic, so it will be fully algo-driven, and the exposure would be controlled very actively. So this is not a fund that is, sticking to the benchmark. This is really an active fund, and our goal for this fund will be a double-digit return and a Sharpe ratio above 1. Before we go to the impact part, now we talked about the algorithms and the alpha, I have put together this chart. This is only, I'm playing devil's advocate here. So what you can see here, this is the projected rise in ESG assets, right? If you see this, you might think that everything is fine. Let's just invest all the money from the current funds, put a new label on it, ESG, and then everything will be fine. To be honest, we have been very unsatisfied with this movement and with the marketing activities that we have seen around ESG, and I will tell you why. We think that there are many ESG products coming up every day, nearly daily, and there are some issues like, there are many rating data providers. It's still not clear who is right, who is wrong. You need to accept that you have a smaller investment universe. Yes, if you cut out more and more stocks, for example, you have a lower diversification. I think this is a topic that nobody really speaks about. And you have lower returns because you need to pay for the data, the regulative stuff, so it's more complicated to run such a fund. But the main point is, from our side, we are asking the question, where's the impact? Where's the impact? If I have a fund A, which invests in global stocks, and now my, the guy from my bank tells me, hey, you need to switch to the ESG product. If you don't know about this, you might think, hey, that's a great thing. Now I'm improving the world. No, you don't. Why? Because if a stock is excluded from portfolio A and moves to portfolio B, what happens then? If everybody in this room says, okay, I don't want to invest in this sector or in this stock, the stock still exists. It's just in a different portfolio. The only effect that we see, and this is what also academic studies show, is that if everybody excludes specific stocks, the valuation gets more attractive. So the buyer that is, in the end, is holding the stocks profits from a cheaper entry price. He has a higher return because the business model stays the same. And we are talking about the secondary market here. I'm not talking about microfinance funds or something. We are talking about normal equity funds. So the question is money provided to support these SDGs? We think no, this is not the case. So again, where's the impact? We have a model, as I told you in the beginning, of two companies. So the first company, the company above, which is responsible for the algorithms, is donating 20% of all the revenue to the foundation, to the Intalcon Foundation. Then the second thing is the foundation is a shareholder in Intalcon, which means it gets another 20% of the profit. And all of the current shareholders also give away 20% of their dividend to the foundation, which just around makes, I think, around 40%, depending on the costs, which also change, but around 40% that we give away to the foundation. So maybe we have been expired by Patagonia, but they give away 1% of the revenue. So we do a little bit more. Now, what is the Intalcon Foundation doing? The Intalcon Foundation is selecting impactful projects and works with NGOs that have a zero cost basis, which means the foundation selects projects with zero operating costs, like Ocean 2050. You have seen the presentation from Alexandra. These are the two projects that we currently support. So the first one is Oceans 2050. The focus here is on mitigating global warming. And to me, 2 or 3 years ago, it was still new that seaweed is 40 times more efficient than planting trees, stuff like this. I didn't know about it. I know about algorithms, but I don't know about seaweed, It's a great opportunity to learn such things, but I will show you how we came up with these ideas, because we have also a very experienced advisory board who supports us with selecting the right projects to support. So this is the first project, and the other one is Rewild, which is financed by Leonardo DiCaprio. The focus here is on preserving biodiversity, which was, I think, the word of the day, biodiversity. So it's about building and maintaining a breeding station of the saola. The saola is a rare animal. I think it's called the Asian unicorn. This is one project that we support. So it's about breeding station, preventing poaching, and to monitor the protected areas. So this is our contribution that we want to make and that we want to be measurable with, right? So everything is clear and transparent. We want to, as we measure the performance of our fund, we want to measure the performance of the impact part. And this is what we miss in many discussions, in many products. We don't do this on our own. As I told you, we are not the experts on impact investing. We are experts on algorithms. So we have established a great advisory board with many great personalities in it. Just to give you an example, Alexandra Cousteau, or you might be familiar with the Jacobs family. So Dr. Andreas Jacobs, who is supporting the SDG goal education, is also part of our foundation, which is an honor for us. You might also know Michael Stich, the great tennis player. He is also a great expert in his field because he has a foundation focusing on HIV since more than 20 years. So these are all people that we can really learn from. We can get their competence and their expertise, which helps us to strengthen the foundation part. So I would like to close my presentation with the quote from our CEO, Mr. Wobbe. I totally agree to this, and I hope that you become part of our mission, or maybe if you are an asset manager, maybe you start your own mission. No matter what, we all need to do something. We all need to make a contribution to this planet. We do it by our algorithms. There are several ways to do it. Yes, and I thank you for watching my presentation, and yeah, really enjoyed to be here. Thanks a lot.